Great. Good day, everybody. Let's get started. My name's Emmett Kilduff. I am the co-founder and CEO of the Fortia Group. I look forward to discussing with you today our latest quarterly report for Q2 2024 of where we think brand valuations are. So let's jump in. First of all, I'll just briefly take you through an update from the Fortia Group. Then, as ever, we'll walk through the Q2 2024 report. We have 4 speakers to work with me on that, including 3 guest speakers from external companies. And then, subject to time, we'll have Q&A. Please submit your questions as we go through via the Q&A tab on Zoom, not via the chat tab. Otherwise, they won't be answered. It's much easier for us to organize the questions via the Q&A tab. And for those that aren't aware, all the recordings of these webinars are available on our YouTube channel. Simply insert the Fortia Group into YouTube and you can review prior webinars and subscribe for future ones. Okay, so from the Fortia Group's perspective, just wanted to showcase 3 slides. One is the positioning of where we are in our industry. We view ourselves as being the lower middle market and one of the very few firms globally that is solely dedicated to the e-commerce sector. What do we mean by lower middle market? Typically, that's companies whose value is between $10 million and $200 million. Once you get above that, some of my former colleagues at the likes of Morgan Stanley start to take over the larger deals. So hopefully that's helpful to position where we are. If you're in that range, we're a specialist firm working with entrepreneurs like yourselves. Wanted just to emphasize our approach to doing exits for e-commerce entrepreneurs and the stages that we go through. There are 8 stages in our view in a proper professional competitive exit process. And the first stage is where you can be the biggest impact on valuation, followed by stage 3. It's surprising to us that so many e-commerce entrepreneurs don't start planning exits early enough in advance. If you're an S&P 500 company and you're thinking about an exit, you start planning 1 to 2 years out. It's frustrating that a lot of e-commerce entrepreneurs we speak to start planning, even in some cases 1 month out. But very few are thinking about it sort of 6 to 12 months out, which is where the smart entrepreneurs, and that's what they're doing. In a moment, I'll take you through exactly what we mean or some of the benefits of early preparation. But we have clients that want to exit in 2026, and they're working with us already to be as best prepared as possible for when they actually give us the green light to start a competitive auction process. So don't delay. If you want to exit on 1 to 3 year view, please start preparing as soon as you can. So early preparation, I mean, the saying fail to prepare, prepare to fail is widely known, but I wanted to give you sort of 3 more M&A orientated benefits or examples as to why early preparation is key. First of all is the flirt, date, marry approach. Just like any great partnership in life or marriage, it's very rare that you go straight to marriage on day 1. It takes time, and it's the same in M&A. So we're big believers in the flirt, date, marry approach. One of the benefits of that is some acquirers, particularly strategics, move slowly or slower like oil tankers. So if you want to get those firms interested in acquiring your business, it's important to get on the radar early. They're not going to move quickly like a speedboat, so to speak. And so flirting with them, then dating with them, and ultimately forming a marriage is the right, thoughtful way to go about it. The second is one of the great sayings in M&A, no battle plan survives contact with the enemy. So no matter how great you think your business is, or your board or investors think your business is, so what? If the acquirers don't think it's great or want further tweaks, you can't sell your business. So we're big believers in getting our clients in front of the enemy, the acquirers, early to receive feedback and think about acting on that feedback to iterate and improve the business before you go to market. Something to think about. And look, the best quote in the history of M&A is the best businesses get bought, not sold. If you follow the flirt, date, marry approach, when you're flirting, you can invite acquirers who are showing interest to take you off the market by offering an attractive bid and preventing an advisor like ourselves doing a proper formal competitive auction process. So hopefully they're sort of simple, high-level examples that drive home the benefit of early preparation. Okay, so let's jump through the report. We have always had 6 key drivers of valuation. So we'll go through each of the 6, and then we will give you our summary view as to where valuations are today, both for FBA-led e-commerce brands and DTC-led e-commerce brands. So first of all, we want to just introduce the speakers. In addition to my colleague Paul Hanley on the far right, he's another co-founder of the Fortia Group and director of e-commerce. We have 3 guest speakers, John Fetto from Grips. Grips have super e-com data based on real spending, and John has some super insights to share in a moment. Austin, a regular speaker, has a great business in the capital market side for e-commerce businesses, but also does a lot of tracking of where public or listed stocks are trading, and will provide insights there. And we always feel it's great to showcase a real acquisition, and the co-founder and president of Forum Brands will discuss a recent acquisition in the beauty space. So lots of interesting discussion points to go through today. So to kick off, I'll discuss global M&A activity. To us at the Fortia Group, there are 4 primary obstacles that are slowing down the recovery in M&A. They are interest rates. There has been some reductions, thankfully, around the world in the last few months, but the key driver is the Fed, and we're waiting for the Fed to reduce rates. Hopefully, that will come in Q4 2024, and that'll be is and will be a key driver of M&A volumes. Valuations, expectations of sellers have got better, but they're still relatively high. And that's something that has to normalize, especially in the market today, in order to get deals done. The elections, political uncertainty is huge. On this side of the pond, it was great to see a clear result in the UK, and we wait to see what happens in the States. But major elections will be over by year end, and that'll be good as we get into 2025. Geopolitics, global tensions have grown and are contributing to the fog in the Ukraine and elsewhere. And that's not helpful, obviously, for global M&A. And I'm talking about global M&A at the moment as opposed to specifically e-com M&A. However, the show must go on. I've been doing investment banking since 2000 for 24 years now, and I've seen many cycles. I've seen the dot-com cycle, the credit crunch cycle, and the show does come back. The show does go on. So save the date. The M&A volumes are going to go up. They've never gone down for 3 years in a row. We've had declines over the last 2 years, and I expect and strongly believe that this year will be an increase for global M&A, and I'll show you some stats on that in a moment. Why? Private equity portfolios are ripe for sale. There's some interesting data by PitchBook back in January showing that PE own about 25,000 different companies, and half of those are over 4.5 years old. And so what I mean by that is a lot of them are coming to a point where they'll be looking for exits. If not, if the PE firms don't crystallize those investments, they'll find it hard to raise further funds themselves. So, watch that space. Corporates are focused on transactions to accelerate growth and achieve business transformation. And that links with the next point, which is AI. AI is a key driver for M&A. And a catalyst for lots of interesting discussions in terms of corporate actions, but also inorganic. It's hard for certain businesses to grow on an organic only basis at the moment, and inorganic growth is one way to sort of overcome that or complement it. So where are we? Well, the best stats I could find in the last month are from EY and their deal barometer, which estimates that we're going to see a 20% increase of M&A by corporates, by big strategics. So you'll see 2021 was a record year. We've had the two down years, 22 and 23, but they're forecasting both an increase for 2024 and 2025, and that's from all of the data points across EY globally. So that's obviously encouraging to see. Doesn't necessarily mean the e-commerce sector will follow that global sectors, but it's again it'll help improve sentiment in across all M&A. If we look at private equity in particular, then the EY forecast a 16% increase, and there's a lot of dry powder at private equity firms that has to be put to work, and hopefully as interest rates come down, we'll start to see that, especially as we get into 2025. So we've had our two down years. We expect to finish on a relative high in 2024, and that bodes well for the future. Again, this is from a global M&A perspective, not necessarily for our sector, but we'll get into that in a moment. Okay, let's dive into e-commerce trends, and I'll ask John to take over from here. Over to you, John.
Great. Thanks, Emmett. Thanks everyone for joining us. So if you're not familiar with GRIPS, we'll go to the next slide. GRIPS is measuring e-commerce transactional data over 60,000 different domains globally, which gives us a really good view into what's happening overall in the e-commerce landscape, allowing us to understand not just traffic trends, but understanding exactly how many transactions and how many dollars are actually trading at any given time. We do provide that data at the upper top level domain, as well as down to the SKU level for thousands and thousands of additional domains. So we'll just jump right into the trends that we're seeing here. So in Q2, and GRIPS is about to release its Q2 overall e-commerce estimate for the United States. We usually do that well ahead of the census numbers, and our estimates correlate very strongly with the census numbers. So if you're interested in getting that number next week when it comes out, feel free to email me. My email is john.fetto@, gripsintelligence.com. But we are going to take a quick look here at how it shakes out for some of the key categories. And when we're looking at the categories overall, we're seeing like the year-over-year revenue change along the horizontal axis and the quarter-over-quarter change on the vertical axis. So you can see here that those categories that grew the most in Q2, we've been talking about this for a long time now, but grocery has still continued to be very hot, with sales increasing significantly year over year, as well as a little bit quarter over quarter. We're also going to drill into some of these, including grocery, in just a few minutes. The other categories that we saw nice growth against were home and garden, which is a big category, and one that we've been kind of seeing as relatively soft, especially given the high interest rates and the lack of renovations and moving that's going on, but it is performing relatively well. We're also seeing apparel combined with sports doing quite well, and we'll drill into that. Pets is another category that we've been talking about repeatedly since COVID, has continued to prove strong quarter after quarter and post regular gains year over year. And some of the categories that are not doing quite as well, or just a little bit soft, electronics has shown a decline year over year, and that's really, I think, led not just, but predominantly driven by the poor business that has been posted by Best Buy, which had not a great quarter. Beauty is another category that even the CEO of Ulta has been talking about in the markets with their most recent earnings report, saying it is a softening category. The demand is letting up. We'll drill into that. There are some opportunities, I think, for growth there. And then health is another one. We're seeing a little bit softer. We've seen in the reports that Walgreens and CVS are struggling in the space, not just in e-commerce, but also in physical commerce. So those are kind of pulling an overall drag on the health category. Vehicles is another one that dropped a little bit year over year, but it is regaining, showing growth a little bit in quarter over quarter. So maybe we've turned the corner on the vehicle market, which has been one of our weaker categories since we've been talking about this with the Fortia group. So now I will dig into some of these categories here. We're going to start out with the grocery category. So with GRIPS, we're able to forecast the revenue across an entire category. Here I've taken about 40 or 50 of the top grocery sites in the United States for the quarter and averaged them up. And we're seeing that year over year, they had about a 16% growth rate in terms of revenue, with those top retailers generating about 2.9 billion in sales in aggregate for the quarter. One of the things we want to see, not just the revenue change, but what's actually behind that revenue change. And we can see that it's interesting that sessions are down, but transactions are up. We know that with grocery growing quarter over quarter, year over year, people have become much more accustomed to making their grocery purchases on a regular basis. And with that, we see people moving a little bit to app purchases to make some of those purchases on a more recurring basis, but we also see people increasing their cart size on a weekly or bi-weekly basis. And we're seeing that reflected in the average order value going up about 8% year over year, and the conversion rate is up 11%. So that's a clear indicator that people are coming back and making those purchases over and over again, which is really what's driving that strong growth for the grocery category. We're going to drill into a couple of those sites that are like kind of standout sites in the next slide. And we're seeing that D2C brands are really driving that big growth. And in fact, all of the kind of top fast growing sites that are catching our eyes really tend to be sites that specialize in protein or meat delivery, including Frontier Co-op, which is really a spice company that also is heavily aligned with steaks and seasoning brands there. So we saw Allen Brothers with the holiday season. Actually, that got on our radar around the holiday season. They saw really big spikes in sales, along with another number of other companies like those industrial thermometers and things like that. So Allen Brothers has ridden that holiday success into the New Year's, and we saw a really great performance for them around the Father's Day period as well. So they're doing exceptionally well. Frontier and their revenues are up 166% year over year, and they finished Q2 with about 2.1 million in e-commerce revenue. The other one we just talked about, Frontier Co-op, is up more than double year over year. Newsk's is up about 115% year over year. They specialize in like burgers, steaks, and other meat products, and they generated about 1.8 million in revenue in Q2. And then finally, the other one that kind of rounded out that top 4 list that's really been kind of on our radar is Maui Nui. That's a venison company out of Hawaii. They are up almost double year over year with about the same amount of revenue as the other one. Noosk's at about $1.8 million. All of these companies have average order values over $100, and their conversion rates are increasing. So it is an indication that people are coming back to these brands, not just buying once for a special occasion, but coming back and buying over and over again. Go to the next slide. So beauty is that other category that I want to talk about as well. People are often taking a look at the beauty category, especially with Ulta's warning in the marketplace that said that sales or challenges are demand is reducing. We saw that their revenues for the top sites were down about 9.5% year over year. Again, a lot of that is driven by some of the bigger sites, including Ulta, which has saw a drop in sales in online in the second quarter. But we're also seeing an interesting trend where sessions are up about 4.6% year over year, but at the same time, the conversion rates are down. So people are still shopping. There is still interest there. They're just not converting, even with the average order value hovering pretty steadily year over year. It's not like the prices are rising and inflation is being the predominant factor there. They really just are having a hard time converting. One of the real success stories that we saw in recent weeks is beauty brands having like their leader sale. I think they generated more revenue in the first week or so of that sale than they generated in the entire month of May. So there are still people out there who are really interested in making beauty purchases online. They may need a little bit more incentive to make those purchases now. The next slide shows some of the top sites that are trending, and as well as with Ulta advising that the weakening demand is across the board. Those sites that are doing exceptionally well do tend to be those that are higher end. The first two that you see on the left, Jo Malone and Creed, are very high-end prestige fragrance brands, both increasing their revenue significantly over the last quarter. Jo Malone coming in Q2 with 6.3 million in revenue, and Creed at 5.3 million. And then you have some of the top skincare, higher end skincare brands, Dr. Dennis Gross and SkinCeuticals. Both of them are up 30% year over year in the quarter. And I think it's also really interesting. Some of the beauty trends that we're seeing is that, people are definitely going more and more to D2C sites, but also Amazon is increasing their beauty business significantly, which is not counted in the overall beauty numbers that we're talking about here. We're really looking at beauty vertical sites as well. But these sites, Joe Malone generated about $1 million in sales on Amazon in Q2. Creed also and Dr. Dennis Gross generated about $400,000 in revenue or more in the last quarter. And SkinCeuticals is actually proudly claims that they are not, if you buy through Amazon, you're not buying from an authorized vendor of theirs. So there's a different approach for SkinCeuticals. We can go to the next slide and we'll take a quick look here at apparel and sports. We did decide to combine apparel and sports because of the trend towards athleisure. There's a clear blurring of lines in fashion and the sporting goods category here. Made more sense for us to combine this. And it is doing pretty well. It's up 3% year over year with about $9.4 billion in sales for some of those top apparel and sports companies that are out there. Sessions in this case are actually down a little bit year over year, but rising average order value. So whether driven exclusively by inflation or people are just spending more on some of their clothes, maybe they're starting to feel a little bit better about their spending. The average order value is really what's driving that growth in the apparel and sports category, because as we said, sessions are actually down and transactions are down, but they're still spending more, helping to drive an overall growth in the category. If you want to dig into some of the top trending sites, we really do have an interesting mix across the board here. We talked about athleisure. You can't forget about that. Lululemon and Alo Yoga and other brands like that do tend to be at the top of our radar of sites that are growing consistently year over year. Alo Yoga finished Q2 with just under $75 million in e-commerce sale, with that being up about 40% year over year. But then we have other sites like Free People, which is kind of like a bohemian fashion brand, and Revolve is really contemporary, trending fashion forward brand. Both of those hitting about 150 million in quarterly sales, and both of them showing a decent growth in revenue year over year. And then Scheels, we've seen some, Dick's is doing very well. REI is struggling with the release or the rollout of, I think, Public Lands by Dick's, but Scheels is another growing competitor in that same space of sporting goods retailers, opening up new stores. And with that comes additional e-commerce dollars. They finished the quarter also with about $158 million in revenue, and they were up about 27% year over year. So one of those sites to watch. And then the last category that we'll look at here is home and garden, as I mentioned too. With inflation rates or interest rates still being high and yet to drop, we're still seeing the growth in the home and garden space being more in the furnishings and in the DIY type of renovations. We're not seeing that growth in like the larger projects yet, but the smaller kind of hardware stores where you can go and buy supplies to do renovations yourself are doing quite well. Those top domains in the category were up about 4.3% year over year in the quarter, with about $9 billion in total revenue. Conversion rates are falling, but the average order value is up. People are spending a little bit more. Maybe prices are rising a little bit faster, helping to propel those revenue numbers up. But overall, the category, I think, is doing quite well in the quarter. And definitely if interest rates do drop in the month of September or so, as we're hearing a little bit of talk about, we would expect this category to heat up in the third and fourth quarter. Now, looking at the top sites that are driving that, again, it's an interesting mix. We see Bob's Discount Furniture, which is doing really well, 132% year over year increase in revenue. Definitely speaks to the fact that people are still looking for a good deal, a discount in furnishing their homes. But we're also seeing Frontgate, which is another home furnishing retailer, not necessarily focused on discounts, doing equally well at about $81 million in revenue for the quarter. Another trend is Frigidaire, KitchenAid, Whirlpool. We're seeing more movement, more revenue going D2C with appliances, and which may create a little bit of strain with their relationship with other retailers if they're generating more of those dollars direct to consumer. And then I want to finish up with like Tractor Supply. We're seeing really good growth in home improvement category, like with Lowe's, Ace, Harbor Freight. Tractor Supply has been one of those smaller brands, generally niche, smaller home improvement sites. It's been on our radar for a while. They posted a revenue increase of 15% again in Q1, and 2023 was a really great year for Tractor Supply. But the last slide, I think we've been hearing in the news about Tractor Supply, was one of those companies that made an announcement a few weeks ago that they were abandoning like some of their DEI and carbon emissions forecasts. And with a result of that, and I do think there's one more slide that may show this if it made it in the presentation here, but when they made that announcement, it was really interesting to see what happened immediately in the day followed. Their revenue skyrocketed to kind of a really nice boost in sales week over week. But that single day spike was short-lived. In fact, ever since then, sales have really been down year over year for Tractor Supply Company because, as a company that's really niche focused in a more rural or ex-urban communities, their e-commerce sales are hoping to reach a larger market base. And in that sense, their announcement seems to have had a dampening effect on demand for their e-commerce sales. And in fact, their revenues were down about 10% since they made the announcement, and their market share relative to similar competitors, Menards, Ace, and so on, has been down about 150 basis points. We'll continue to watch it, and please check out our website for more fast movers and other e-commerce trends. You can visit gripsintelligence.com/insights. So thanks again.
Great. Thank you very much, John, as ever. Great insights. So we've looked at global M&A, we've looked at e-commerce trends. Now we'll look at public market comps, and I invite Austin to take the lead.
Awesome. Thanks, Emmett. And thanks everyone for joining. Just as a quick point of background, the founder and CEO at a company called DrivePoint. We primarily would build a software platform and provide some services on top to help lower middle market and middle market e-commerce and omnichannel brands with financial analytics, financial planning, financial forecasting. And so we have a great private company data set. And we've also been tracking this public company basket for almost 5 years now to sort of understand the valuation trends across this landscape. You can see some of the logos here. We've selected, sort of curated this list and have updated a little bit over time to focus on brands that are selling primarily through a direct-to-consumer business model, both online and offline in some of their own showrooms. So that's the sort of filter for the securities that we've selected here. If you flip to, so this slide basically just is the latest snapshot in terms of where we are. I tend to focus generally on the median line with maybe a second look at the weighted average line. That's a market cap weighted average. So you can see the median brand here doing about 500 million in revenue over the last 12 months. There are quite a few larger brands in there. Growth has slowed a little bit, shifting toward revenue change. So about the median growth in revenue about 4%. Here, gross margin hovering around 60%. EBITDA margin, which I'll talk to in a minute, has stayed relatively steady on a median basis, but is actually climbing on an average and a weighted average basis. I'll dive in there in a second. And then the latest readings, pinning the needle on valuation metrics at a 1x multiple on sales and about an 8x multiple on EBIT. And so if we change to the next slide, we can sort of see how that's been trending. The circles here are the data points that I've highlighted on the right side of this chart are the last 3 times that we've done this webinar. And so you can see there hasn't been sort of a dramatic amount of change. Really, we were coming off of the highs towards the end of 21 and into 22. And we've been oscillating around sort of a relatively standard band here, somewhere around 1x sales with some bumps in the chart there a little bit, and fluctuating really between sort of like 6 and 10 in terms of the multiple on EBITDA, really with the most common readings that we've been seeing in sort of that 7 or 8 range. So I think, the overall read here is like a period of remarkable stability in terms of valuation trends. These companies really haven't seen huge swings from a valuation standpoint. And I think that's actually created some interesting behavior at the individual stock level. So flipping to the next one, just to highlight a couple of interesting names. I think Obviously, the top end of this stack, Lululemon, Crocs, in terms of market cap and revenue, have continued to do well and have outperformed. So Lulu still sort of holding the banner here on EV to sales at a 3.6x multiple on sales. But obviously a quite profitable business at almost 30% EBITDA margins, still growing relatively strongly, even off of a very large base. I think, I've said it, I think at every single time we've gotten together on this webinar, but that remains the best in class benchmark for what a soft goods or an apparel brand should look like. Yeti, obviously, I think is a kind of a bellwether for more hard goods and consumer durables. We can see that, they are as well sort of trending high on the EV to EBITDA multiple, but as sales growth has slowed, their EV to sales multiple has dropped a little bit. The valuation hasn't really increased in step with that sort of a little bit of sluggish decline in sales growth. And then across the board, below the line here, I think there's a divergence in terms of companies that are doing really well and sort of are on the up and up. I'll look at companies like Warby Parker, which has had a really remarkable turnaround, Hims, which is doing incredibly well. Even sort of laggards who kind of been hanging around the hoop for 5 or 10 years, like the Honest Company, is starting to show some improved business growth here. In diving below the surface, I think the most interesting thing to me in looking at some longitudinal trends over the last couple of readings, so really since 2024 and present, the market has responded in terms of the operators have clearly responded to that stagnation and sort of valuation multiple, and really a focus on EBITDA as the driving valuation multiple over sales. And that's been reflected in what these companies are actually doing. So we've seen that sort of locked in for almost 2 years from a valuation perspective, and we're starting to see that show up in the data, the fundamental data from these companies. So from a sales perspective, looking at the growth trends, almost everybody is down in terms of growth velocity. So brands that were trending downward, already had a negative growth velocity, are either further down or being able to hold the line. Brands that were growing really, really fast, among them Figs, Hims, growth has actually slowed quite a bit over the last couple of readings. I think, in the top end from 54% down to 30%, and on the lower end, brands that were shrinking 10 or 11% a year are now shrinking almost faster than that. But across the board, we've actually seen EBITDA margin increases almost across all of these companies. So just to sort of run down a list, in 2024 alone, Crocs has added 2 points of EBITDA margin. Lululemon has added 2 points of EBITDA margin. Yeti has added 7 points of EBITDA margin. Vera Bradley has added 6 points of EBITDA margin. Hims has added 9 points of EBITDA margin. Honest Company has added 5 points of EBITDA margin. Laird Superfoods, which is sort of a micro cap that miraculously got out in 2021, they're still losing money, but they've improved EBITDA margin by 34 points. Canada Goose, a large scale brand, still up a point. Warby Parker has added 8 points of EBITDA margin. Oddity, which is a beauty company, has added 4 points of EBITDA margin. There are still some losers in here. Allbirds, sort of like the most public example of the D2C sort of flop at the moment in the public markets. EBITDA margin actually down 12%, so they're going the wrong direction on both growth and profit. Oxford, which is a more legacy apparel brand, down 3 percentage points, and Purple Mattresses down 12 percentage points in EBITDA margin. But by and large, across the board, what we're seeing is these companies have responded to what the valuation market is telling them, and are focused on getting more profitable, even if that means pulling in the reins a little bit on growth. And anecdotally, that's certainly translated into the private markets as well. We're seeing it's almost a zero conversation. And Emmett, I know you had some color on this last time we spoke, but almost a zero conversation if a brand is break even, is not break even or profitable in terms of acquisition prospects. And we're also starting to see even working capital lenders and others who are providing sort of credit capital for these companies to make inventory purchases primarily, or fund marketing expenses. They are also the bar has come up in terms of what the expectations are from a profitability perspective. So I think overall, if you're an operator in the middle market or lower middle market, a year ago we were saying, okay, it's time to get profitable, and I would say the time has come to be profitable. And so if you're not there, the urgency should be pretty clearly on that focus area, or the valuation and the exit potential is certainly going to go down from here. So overall, big takeaway, valuation in the public markets, the multiples have been stagnant, but we have seen that behavior shift from the operators, and obviously a clear focus on profitability, as almost all of these companies, whether they're overperforming or underperforming on growth, have figured out a way to get more efficient and get more profitable from an EBITDA standpoint over the last year.
Great. Thank you very much, Austin, as ever. Great insights, and thank you for continuing to track all those brands for us. Also great to see solo brands get to a 10% EBITDA margin, which is relevant for the aggregators and the smaller brands on the call. So there are deals getting done. It's not all doom and gloom. So for today, I invite the founder and president of Forum Brands, Ruben Amar, to talk through a recent deal. Welcome, Ruben. Over to you.
Thanks, Emmett, and thanks for all the details that were mentioned so far. So yeah, I'll talk a little bit about a recent deal that we've done, but I think for those of you who have heard about us, Emmett definitely heard about us before. We worked with him on a few deals in the past, but we really moved into being very personal care focused. The idea for us is really to address all the needs around women's wellness and women's health. And so ever as part of this strategy that we really kind of like dived into and put a lot of efforts behind, call it like a year and a half, 2 years ago, with the recent acquisitions and more importantly strategy, ever fits really, really well in that. So that's a deal that came to us through one of our close kind of like network advisors that we know. It started by a founder that is based in California. She was multiple times entrepreneurs. This brand was part of a bigger company called Stella & Dot, which maybe some of you have heard about. It's in kind of like the jewelry space. They carved it out, and at the end of the day, it was a small team, super highly profitable business. And maybe Emmett, you can move to the next slide, so that at least people can see what we're talking about. The brand really positioned itself very nicely into the perimenopause space, which is, think of it as kind of like women in their late 30s up to the menopause years, which typically are the 50 years. And this brand really kind of like focused on very high quality products. So straight away when they started business, they owned and filed and owned a patent through a formula called SR10. And all of that is with regards to the change in hormones that women face over time, whereby Ever comes in a little bit before menopause and address those changes with very high quality products. So we're talking about AOVs that are very high, so much higher than, like, I would say, a lot of our other brands that are on Amazon and D2C. So this business is at around $90 to $100 AOV. So AOV is average order value. What's good about this business as well is that it has a very, very large repeating revenues aspect, meaning that very high percentage of revenues comes from people that are shopping a second time, a third time, a fourth time, etc. They have a subscription business as well. So like half of the business is kind of like subscription based, and it's 100% DTC. So we at Forum, if you think about it, we used to be very focused on Amazon before. We moved away from acquiring businesses that are only on Amazon. So now we are doing much more efforts when it comes to buying businesses that are 100% D2C or 100% retail, or a mix of the two, or a mix of the three, just because we have now the capabilities from an operational perspective to integrate those businesses very well and really supercharge them to grow significantly. And Ever is a really interesting part of Forum's story right now, because with the acquisition of Lola, we kind of like took a very large part of the life cycle of a woman of age of 18 to 40 years old. And then we have other brands that are kind of like in the pregnancy, in the post-pregnancy, in the kind of like anti-aging that covers a little bit more years. And what we were really missing is kind of like the pre-menopause, menopause years. And Ever kind of like really complete this whole cycle very nicely. And so yeah, that's the products. I invite you to go to ever.com. You'll see much more details in those slides. If you move to the next one, you know, those are the things that are really, really liked. LTVs are more than 200, and lifetime value, which is great because cost of acquisitions are lower than that, and so we are profitable very quickly on every sale that we make. Very strong unit economics, you know, high brand level EBITDA margins, and we really see the opportunity with Ever in getting the business into all the channels that we already operate in. So Ever, Emmett, if you go back to the first slide, yeah, we really, the team has done a great job in repackaging those products so that they are retail ready. And what's exciting is that we see a great opportunity for us to get those products into retail in a lot of retailers that we already have a relationship with, but also on Amazon. You know, we are experts in Amazon because that's how we started the company, and this business doesn't sell at all on Amazon. So very excited about that as well. And finally, I will just stop here. Very different from the majority of the acquisitions we've done prior to Lola. Here we have all the team members join Forum as well. So it's a team of 6 people that now are fully employed and work with us at Forum, which we're really excited about because they bring a lot of talent and a lot of things that we don't really master that well that bring around the table. So that's Ever. Happy to address any questions if there is anything, but yeah, there's still M&A out there.
There is still M&A out there, absolutely. The show must go on, and it is going on, just in a small way. But if anyone has any questions for Ruben or the other speakers so far, please do submit them via the Q&A tab on Zoom, and we will hopefully have time to get to those. So section 5, the last 4 sections, the first 4 sections are effectively outside the control of the entrepreneur of a brand, whether it's global M&A conditions or e-commerce trends. The next 2, number 5 and 6, are more within the control of the entrepreneur. And I'll ask my co-founder, Paul, to explain what we mean by brand metrics. Over to you, Paul.
Thank you, Emmett. Nice to join you and all of our attendees on this webinar. This is the first webinar I've attended. The goal here will be to attend future ones and show you, as I will today, what current focus metrics are, but how they change over time as well, quarter on quarter. So by way of introduction quickly to myself, my background is exclusively in e-commerce operations over the last 15 years, delivered omni-channel growth strategy for brands like Philips, Turtle Beach, and for all the parents on the call, Water Wipes, one of the fastest growing baby wipe manufacturers globally. I primarily work with our clients to understand and articulate where their current performance is in terms of e-commerce brand metrics. I do a lot of advisory work with our clients, building robust forecasts and articulating their business through the lens of acquirer or investor interest. I also make sure that they're properly prepared from a brand metrics performance stance to undergo an extensive due diligence process. So to introduce myself, I'm heavily involved on a quarter-to-quarter basis in the topic of brand metrics. So on the left-hand side, it's no surprise, it's been mentioned on this webinar before and on this current one, that on a high level, it's been incredibly tough for e-commerce brands. 3 macroeconomic factors impacting overall performance. Number 1, consumer health concerns. Really what this translates to for e-commerce brand metrics is essentially gross margin. So inflation rates globally still impacting discretionary growth spend. The US health of the consumer, more than 60% are admitting they're living paycheck to paycheck. Household costs are increasing across the board, from food, fuel, through to geo-global political issues. And it's hampering brands' ability to charge a premium for their products or put price increases to counter some of the increased costs that are coming from investments below the revenue line. And number 2 is the cost of capital is increasing. Of course, it's harder for both brands and potentially acquirers to raise capital, to invest for growth. and to get cost-effective capital, which is an overall impact towards profitability. Finally, then, more close to home in terms of an e-commerce P&L, there's increasing operating costs across the board. In many categories, we're still seeing a high and rising cost of acquisition for customers. This is driven obviously through global pandemics, huge interest in e-commerce sector for more established brands, public brands with significant budgets to spend on both upper and lower funnel activity. Fluctuating costs still happening on the fulfillment side, on manufacturing side. Operating fees increasing across the board, both on DTC models and Amazon models. New fees being introduced, as well as rising current fees. And then an increasing need for data and insights. It's interesting with all this increased competition that's coming into the space, as particularly on the DTC side, there's an increased need to purchase data and insights to understand what's happening in the market, what competition are doing, and what the customer is doing and how they're behaving to these changes. But the problem is it's expensive, and it's having a dramatic impact towards OpEx levels that we're seeing for lower middle market e-commerce brands that are scaling. So it's not all doom and gloom. That seems to be a key phrase on this webinar. The fact on the left-hand side is it has been tough for e-commerce brands. However, there is significant appetite for brands that are performing well under these circumstances. The environment is not set up for slightly easier success as we would have seen in 2018, 2019 for e-commerce brands. It's tougher out there. Therefore, it's more indicative of brands to have a capital B at the start if they're performing well under these circumstances. So I've split this out into direct-to-consumer and Amazon models. I have a feeling that most brands out there right now are adopting an omni-channel approach. They're looking at both of these primary e-commerce channels in conjunction with maybe traditional brick and mortar as a route to growth. What are the most important metrics that are cropping up on both these channels? So there's a split here of both financial and operational metrics. Financial metrics are still driving, which is no surprise to us on the call, still driving the key decision making that's going towards valuation of these brands. Gross margin, just to double click on this, you know, I often find myself saying that 15 is the new 20. That's talking about net margins, what's acceptable, what's potentially interesting for investors and acquirers. Back in 2018, 2019, it seemed to be 20% EBITDA margins. Now that's gone reduced down to 15%. But really what this correlates to in terms of gross margin is I see a lot of P&Ls across my desk month on month, quarter on quarter. And it's clear to say that the correlating EBITDA margins that are seen are not super attractive if gross margin is not 75% or above. Obviously, when you look at the consumer health concerns, this is getting increasingly tough to do. The modern consumer is more deal and price conscious. But if you can show significant gross margin, it means that you have a viable product. And based on quality and cost, you're able to attract and acquire customers at that high level. Then the correlating net margin obviously is a key defining factor. What do the investments look like below the line? Contribution margin along the way. Contribution margin can be twofold. Contribution margin can be effectively more relevant for family offices, PEs, and DTC acquirers that have infrastructure in place. So they may look at your P&L and obsess more over the contribution margin. What I mean here is your revenue less your cost of goods, less your fixed fulfillment and operational fees, and less your variable ad spend. So excluding all those fixed costs that go towards running the actual business and looking at what the contribution margin with an OpEx peg can look like for them. Contribution margin here can also mean the split of your hero product or ASIN versus the rest of your portfolio. So on a unit economics basis, does the portfolio that you're producing make sense? Are you buying growth by launching new products, or are you actually developing high quality, long lasting products that are contributing positively on a whole to the P&L? The next two are different brand metrics that are related to the variable ad spend. So what I love about e-commerce P&Ls is, for the most part, they're relatively fixed. Your cost of goods is dependent on agreements that you have with manufacturers. Your fulfillment fees, logistics fees are relatively fixed costs, although they fluctuate based on size and weight. Really, where it comes into the owner or acquirer's hands is on a variable ad spend, or on that OpEx level, what the investments are looking like to run the business. So LTV to CAC ratio here, really a defining factor for the success of many direct consumer brands. It's the correlation of how many times your customer has purchased over the lifetime, what the correlating average order value has been, how stable your pricing has been. It's a really encapsulating brand metric, because it encompasses so much versus what the cost of acquiring that customer has been. So typically, what's super exciting for investors here is anything with a 5x ratio. Of course, we're referencing specifically the lower middle market sector here. Effectively, they want to know if they're to flood capital into this, what does the return model look like based on that spend? TACOS then telling us total reliance that the top line revenue has towards that ad spend. Again, we're seeing for DTC brands, anything in and around 15 to 20% TACOS is super attractive. I've seen anything from 60% TACOS all the way down to 5% TACOS. Just a note on TACOS, for those that maybe have a gross margin that is less than 75%. For those spending maybe 5%, there's more defining factor for the consumer driving towards purchase. Investors may look at this as a negative, as they will apply an industry standard peg towards that, what TACOS is more going to look like going forward. So you need to be mindful of that. Just quick call outs that differentiate on the Amazon side. We're talking about gross margin, net margin leading the way here, but also market share. Of course, it's easy via Helium 10 and other tools like this to get an indicative view as to what market share you have in your subcategory, how you're stealing market share, gaining market share in that sector from competition, how stable that is, how you're growing that over time. And then differentiated metrics on the Amazon side, ratings, reviews, again, how customers are responding to your brand, what their views are towards quality and your positioning. Due diligence focus points here, I just want to touch on what's cropping up. So first party data, very important, especially for DTC brands, how you're harvesting and using that first party data that you're getting from customer insights and customer engagement. Intellectual property, again, brands with a capital B, they want to make sure that investment or acquisition post this, that it has differentiation and stability in market, and there's a moat to competition. Data-driven forecasts are very important going forward, showing that there's stability and growth within the asset, and that there's the potential to expand this to omni-channel capabilities. So looking at how you take the portfolio off potentially e-commerce and look at expanding it into traditional brick and mortar retail. Next slide, Emmett. Finally, this is a 1 minute shameless plug from myself. As I say, I spend a lot of time working with brands articulating the performance. Emmett brought you through a slide that showed our 8-step exit process. This is very indicative as part of step 1. We do a lot of work with detailed valuations and brand metric performance for every e-commerce brand that we work with. But we also offer this as a standalone service for those of you that are looking for a non-committal engagement with the Fortia Group. You may want to just get a detailed view with an acquirer lens as to your valuation currently. And due to our e-commerce experience in-house, we also do a pretty robust audit on your operations and financial performance and give you recommendations to boost that valuation in the coming months and quarters. So for any of you that want to know more about the service or learn how to get involved, reach out to Emmett or myself directly.
Right. Thank you, Paul. So I want to spend most of the remaining time on valuations, our view on the range. very briefly, in terms of deal dynamics, you may have seen this slide before. The actual dynamics surrounding the deal are very important drivers of valuation. That could be the situation of the shareholder, the situation of the acquirer, whether one has advisors or not, how you go about marketing and distribution, what are the synergies between your business and the acquirer's business, and ultimately the deal structure in terms of things like how much upfront, how much deferred. I just want to focus in on marketing and distribution very quickly. A small plug, last January, we hosted the world's first one-day conference for acquirers of e-commerce brands in New York. And next January, we're making that bigger and better. It'll be a week-long conference for about 200 acquirers of e-commerce businesses, ranging from strategics, PE firms, family offices, and aggregators. We're mentioning that to you all because we invite between 5 and 10 entrepreneurs who are selling their businesses to pitch to the audience. Think of it as a Shark Tank on steroids. There's 200 acquirers in the room. There is no better forum for one to launch a deal in January off the back of full year results. If that's of interest, please do reach out. Okay, so the question everyone wants to know is, where are valuations? So we've taken a slightly more quantitative approach to how we come up with our view on valuation. First of all, we want to look back as to where valuations were in December 2021, the highs, and then we'll give you our thoughts on where they are today. We've gone through 6 topics on this webinar so far. They're the drivers of valuations. The first 4 are outside of the entrepreneur's control. The second 2 are within the control. So we've talked about global M&A activity, e-commerce trends, public market comparables, e-commerce M&A activity, brand metrics, and deal dynamics. Back in December 2021, it was the perfect storm. We're scoring all of those metrics 10 out of 10. There was lots of M&A, e-commerce trends were perfect with COVID. Public market comps were trading at an all-time high. There was a crazy amount of M&A. Brand metrics were going great, and deal dynamics were great because there was particularly a lot of firms hoovering up e-commerce brands. So in the middle of the slide, you can see our score is 60 out of 60. So that impacts valuations. So for FBA-led brands and DTC-led brands, you can see the valuations that we're trading. For FBA, the highest valuation we've heard of to date is 7x seller discretionary earnings. And for DTC, they're well into the teens, particularly for those businesses that had high subscription revenue. Those multiples exclude inventory. So where are we today? Roll on to July 2024. Unfortunately, the score is not 60 out of 60, and we're trying to be very realistic. We're not trying to paint an incredibly rosy picture here at the Fortia Group. We want to be, realistic to all the entrepreneurs and the buyers on the call. So in our view, global M&A activity is at a 4 out of 10. E-commerce trends are 3 out of 10, depending on what subcategory you're in, as John was showing. Public market comps are down, although improving. Arguably, that could be a 3 instead of a 2. E-commerce M&A activity, unfortunately, is definitely a 2. One might argue for a 1. Brand metrics, it depends on the business, but in some cases, on average, it could be 3. And deal dynamics 4, maybe 2. So where does that leave us? It leaves us at a score of 19 out of 60, which is clearly, relatively low. That impacts our view, our house view, as to where valuations are today. So what we're saying is, for FBA-led brands, it's incredibly unlikely to get anything above 5. And those that are getting in the high 3s to 5 are what we call, diamonds. They're the very rare unicorns who have all ticked all the boxes, such as very high repeat purchase in a great category or favorable category, etc. There's a lot of distressed at the moment. We're sort of saying distressed brands are getting 1 to 1.5 times STE, and most typical brands that are growing, top line growth and profitable, are getting somewhere between 2 and getting towards the high 3s. That's our view, and that's view in hundreds of conversations every quarter. For DTC-led brands, which typically trade at a higher multiple than FBA because they own their customer, we are seeing distress at up to 2x in some cases. Brands are just getting their inventory paid for. The growing and profitable is unhelpfully wide, but that's because we're seeing such a range. You saw Austin talk about the median of listed stocks being circa 8x. Well, unlisted stocks have to trade at a discount to listed stocks, so it makes sense to have a range our cap at 8, and we're saying that goes down to about 2x, depending on the business, depending on whether it's subscription and so on. If it's subscription in a really attractive category, there is still the opportunity for it to maybe be classified as a diamond, and if there's a competitive auction process, maybe get a high single digit or even double digit. So that's where we see it today. Now we want to put our neck out there and look forward. And I'll finish with this slide. Let's look ahead to January 2025. A lot of the entrepreneurs on the call will be thinking about working towards a deal. So today it's 19 out of 60. We see January 2025 scoring 29 out of 60. So there will be better global M&A activity due to reduced interest rates. E-commerce will hopefully improve as the consumer feels more confident on the back of reduced interest rates. Comps will hopefully recover, etc. And so we think that there will be a slight recovery in valuations, but more importantly, there's a massive increase in the ability to just get a deal done. There will be more buyers fishing around. There will hopefully be more term sheets, LOIs, and just getting a deal away will be more likely. We've run out of time, but if anyone wants to reach out to sort of to discuss exactly what a diamond is, or where we think your brand is on these charts, please reach out to us here at the Fortia Group at inquiries@thefortiagroup.com. I'd like to thank all our speakers, to John, to Austin, to Ruben, to Paul. Appreciate all your insights, and look forward to doing the next webinar, hopefully again, even more positive in 3 months' time. Thank you all. Have a good day. Bye-bye.